Financial management is important for every business owner. Every decision that an owner makes has a financial impact on the company. Therefore, it is important to plan and understand at least basic financial operations. While below this video, you will find a list of several online financial management tools. Today we will concentrate on 3 types of financial calculations in Google Sheets. First of all, Google Sheets is available for anyone by simply having a Gmail account. In order to access it, go to Google Apps and select Sheets. You will notice that Google Sheet has the same elements as a Microsoft Excel document. Within the Opportunities for Arts and Crafts project, we have been concentrating on 3 different types of calculations to be presented today: cost-income situation, pricing calculations, and stock keeping. The templates that you can download for yourself are below this video, and a case study example for each of these files is also available. Now, let's take a deeper look at the cost-income calculations and analysis. First of all, you should notice that here we would have 2 different categories, each of them divided into 2 other columns. In the cost section, you will have to list all your expenditures incurred, such as costs of goods or services, for example, raw materials or the salary of the person producing the product. Administrative and selling costs, such as place rental or the salary of the administrative staff or marketing. And taxes to be paid, depending on your national laws. If these expenditures were paid in cash, they should appear under the cash column. If they were paid with credit card or bank transfer, then under the bank column. At the end, the total cash and bank expenditures will be calculated for each subcategory by summing up all the costs listed. In the income section, you should also list the sum of products or services you have sold in 2 different columns, cash or bank. At the end, the total income should be calculated by summing up the incomes received in cash or via the bank. If you produce more products or offer more than one type of service, it is advisable to indicate the costs of goods and the corresponding income separately for each product or service. This way, you can calculate the profitability of each product or service separately at the end. Now, let's see what you can use this table for. The most important calculation that you can do from here is the profitability. The profitability ratio assesses a company's ability to earn profits from its sales or operations. Profit can be of 3 types. Gross profit is the difference between sales and the costs of goods sold. The operating profit is the difference between sales and the costs of goods sold, plus selling and administrative expenses. And finally, net profit is the difference between net sales and all expenses, including income taxes. Higher ratio results are often more favorable, but these ratios provide much more information when compared to results of similar companies, the company's own historical performance, or the industry average. The second calculation that we will concentrate on is the pricing. In this case, the table has to be filled in separately for each of your products or services. In order to obtain the minimum price that a product or service should have, first of all, you will have to list all the costs for producing the product or delivering the service. To make things easier, the cost types were divided in 3 different categories: materials, salaries, and other costs. For each listed expenditure, you will have to define and fill in the price of purchase and the necessary quantity for one piece of product or one service. The last column, total cost for one unit, will be calculated by multiplying the price of purchase with the necessary quantity for one unit. After you fill in each category, the total cost for producing one unit will be calculated by summing up the totals obtained at materials, salaries, and other costs. Now you need to define the profit margin. Your business's profit margin measures what percentage of revenue your business keeps after paying for outgoing expenses. The higher the profit margin, the better for your company, but my advice is to establish a minimum of 50% margin. A 50% margin means you have a net income of 0.5 cents for each euro of sales. The profit margin is calculated by multiplying the total cost for one unit with the profit margin percentage. Next, the total cost with profit margin will be calculated by summing up the total cost for one unit with the profit margin sum. The next thing to be identified are the taxes to be paid for each product or service that you will sell, depending on your national laws. The taxes are usually defined as percentages. The last thing is to define the total price of the product or service by summing up the total cost for one unit with the profit margin total and the tax total. These calculations can help you in several things. Setting up the minimum price you should request for your product, setting up promotions for your services or products without losses, quantifying your own work with producing the product or delivering the service, or calculate your business's sensibility to certain raw products that you necessarily need for production. And finally, we will take a look at the stock keeping calculations. This file should be filled in separately for each product you produce. You will have to fill in two different sections, the starting stock section and the needed material for one product section. The last section, remaining stock, should be an automatic calculation resulting from the two other tables. Let's start with the starting stock. Here you should list all the materials you have, what quantity you have at each listed material, and what's the price of one unit of the respective material. The last column, total value, will be calculated by multiplying the available quantity from each material with the corresponding unit prices. Basically, this section calculates the value of materials you currently have on stock. Now, we will continue with the second section, and we will list the needed materials for one product unit. The listed materials should be kept in the same order as in the previous table. After listing all the materials needed to produce your product, in the second column define the needed quantity from that particular material for producing one unit of product. And last, whenever you sell a product, you have to list the sold quantity in the sold products column. Once you fill in the first two tables, the third table will be generated indicating the remaining stock you have from each material and the value of your current stock. With the help of these calculations, you will be able to know several aspects. For example, how many products you can produce with the materials you still have on stock, what materials do you need to purchase when a new order comes in, and what are the costs of your purchase. With these three types of calculations, you can put the basics to a good financial management of your business. Use them wisely, and don't forget, below this video you can find a list with other financial tools, but also the Google Sheet templates and examples for each type of calculation. Keep up the good work and happy financial management!